False documentation and information is a consequence of the AI. It's false identification.
Given the advancement of AI and deepfakes, as you said, and also the fact that we are in tense, uncertain times, what types of fraud would you say you're on the lookout for now? And is the nature of the fraud changing you've seen over recent years? My name is Deepesh Patel, editor at Trade Finance Global.
And I'm James Daly, the CEO of Allianz Trade, the Americas.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast, brought to you by TFG. Today, we're excited to launch our new CEO series, providing you with views from the top in trade, trade credit, treasury and payments. Before I introduce you to today's guest, I'll set the backdrop. We're days away from the US election. Economic uncertainty has become a given. The trade credit insurance industry has to grapple with this, really standing at the juncture between risk management, technological innovation, and regulatory evolution. From the lingering effects of the pandemic-induced supply chain disruptions to the emergence of sophisticated financial fraud schemes, businesses face an increasingly complex landscape of trade-related risk. This discussion comes at a particularly pertinent time, as the global insurance industry is expected to experience a compound annual growth rate of 10.7%. At this rate, the market is set to swell from $14.9 billion to $41.1 billion by 2023. As traditional risk paradigms shift and new challenges emerge, understanding how trade credit insurance is evolving becomes essential. That's why today I'm joined by James Daly, CEO of Allianz Trade Americas, for an in-depth discussion on the current state of the trade credit insurance industry and also what's happening from a US perspective. James, welcome to Trade Finance Talks.
Thank you. And we're very glad to be here.
It doesn't sound like you have a North American accent, so let's start with the basics. Who are you? Where are you from? And what do you do?
Yes. So James Daly, I've been with Allianz Trade now for just over 20 years. I started in the UK business, as you can detect from my brogue, in many of the operations that we have within Allianz Trade around the world. But 10 years ago, I took the opportunity to come out here to the Americas region, really to understand how we could unlock the credit insurance potential here. It is the largest economy in the world, but it has historically been one of the lowest penetrated credit insurance markets. So really, 10 years ago, I took the opportunity to come over here and understand how we could introduce the product to more people, diversify our offering here, launch some new lines of business as well. So yeah, it's been a fantastic 10 years. And I still happily kept hold of my European brogue.
Thank you very much. So from London to Paris to New York, all very great cities. To start off with, and to bring this down to some of our listeners, can you answer this question? What does a typical day look like in your role as CEO of Allianz Trade Americas?
First of all, when you look at trade credit as a solution, and when you're in London or Paris, I would say the penetration rates there are around 15% of companies that could use it or have heard of it are using it. In the US, that's down in 2.5%, 3% of companies who've even heard of it, and those that have heard of it are still not that likely to use it. So a lot of our time in the US, particularly as the CEO, is being an evangelist for the product, trying to help organizations, trying to help future customers understand what the product is, what benefit it brings to them inside their organization. Because it's not just simply a risk transfer tool. It has so many other dimensions to it. So really being that front of house, evangelizing what we do, talking to people like yourself, talking to other publications, getting involved in industry networks, etc. So that's constantly ongoing because, there's over 50 million companies in the US that could buy trade credit, and the marketplace has got probably 50,000 policyholders. So you can see the upside is huge. So a lot of time worked on in that space. Then clearly within the US, the risk managing that portfolio of risk, understanding what companies are getting into some challenges, understanding how those challenges need to be managed from our side. That's a constant daily routine, getting to make sure that we don't suffer or our clients don't suffer from some very large losses that could happen if a big US corporation failed. Evangelizing, managing the risk. And then I would say then talking a lot to our teams, making sure that they're understanding the faces we face in the new world, how we're using IT, how we're using artificial intelligence, how we're using other tools to make sure that we become more efficient so that we can access more data, analyze that data more effectively, efficiently, working with those bodies within the team, within the company on a daily basis to really understand what's ahead of us and are we getting ahead of what's ahead of us. The beauty about this job is not every day is the same. That really is true. You'll wake up and there'll be, as you say, with the election coming around the corner, or we hear companies suddenly announce something strange happened. Every day there's a new event, which kind of distracts you from an average day, but that's what makes the job interesting and fun as well.
Thank you very much. I guess let's just take things back to basics, because actually the history of trade credit insurance, or even the history of your organization, doesn't necessarily lie out of London. I mean, you could probably date back to a time in St. Louis or even before that in Venice. Is that right?
As a history lesson, probably the very first trade credit contract was done in the Medici period in Venice, but it was probably merchant to merchant. So not through through insurance companies as we know today. But the company that I'm sitting in today was the very first trade credit insurance company that was set up in the world, and that was over 130 years ago. It was set up in St. Louis. And why St. Louis? Because that's where the north to south, east to west railroads crossed, and that's where all the trade was occurring, or the trade was being managed in those days. So it was an obvious place for trade finance and trade insurance to get its foot in and help companies protect themselves. As time evolved, after the First World War, Europe needed to rebuild, and a lot of the commodities and building materials that needed to be going back into Europe were coming from the US, and they were coming out of the port of Baltimore. And a lot of people were worried about sending goods across the Atlantic. So we relocated the business to Baltimore, which is where our headquarters has been for the last 100 years or so.
A real significance in that location then, Baltimore. Moving over to the US, we're days away from the US election. I'm not going to ask you results are going to be, but there's a lot to unpick right now. There are a lot of businesses that are experiencing extreme volatility, uncertainty, whether that's from the recent IMF World Bank meeting or the recent Fed rates cut. How are businesses coping with this, and what are their attitudes to this real uncertainty that problematically is now becoming the norm? And how's this also impacted their appetite towards trade credit insurance?
One of the advantages for us and our clients is that when you have uncertainty, whether that's in the political times that are more constant or you're not at a point of change, there's always a level of uncertainty in the economic cycle. When it gets the moment that level of uncertainty is clearly getting stressed, that's when people come to us, because we're able to sit alongside our clients or alongside some of our partners and help our clients navigate their way through that, because they're not going to have, it's our job, it's our expertise to focus on that uncertainty, to forecast, to monitor, to keep working on a minute by minute basis. Our clients, they're going to be managing their business in line with what their daily requirements are, whether they're manufacturing, providing services, whatever. That's what they're going to be focusing on. And what we're able to come in is be that extra pair of hands, extra pair of eyes to help people navigate through that. And you're right. Right now, that level of uncertainty is tremendous. As you say, the Fed rate was the top level for a number of years. That in itself had created a huge stress within many organizations, because when they built their business models, historically, they were built on different debt models, and those debt models just get more and more expensive. We're helping our clients understand whether their customers are able to withstand those increases. Even though the Fed have started to cut the prime rate, still seeing that cost of debt is coming down very, very slowly. So it's times that, the debt inside companies is still hard to manage. We have to keep an eye on it even further, because what will happen when you have uncertainty, as you know, in the US economy, 70% of it is driven by consumer consumption. When you have uncertainty in that space, and particularly when there's going to be potentially a change in the political landscape, people become more careful and they spend less. And then that contraction has a huge effect on supply chain. We will model that, help our clients understand, it's safe to continue to trade with these customers they have or not. We'll guide our clients through that process. The next government will deliver in terms of economic policy. I still think it's slightly unknown because, we're in an election period, so it's full of rhetoric, it's full of big promises. We all know that after dust settles, that will start to become more clear. And again, we will start to work with our clients to interpret what those policies mean for them. Because around the world, we've got 1,500 people analyzing data every day to help our clients. They can't make that investment. They should be doing what their core competence is. Keeping our finger on the pulse with that resource is critical to our clients.
Let's talk about fraud, because that's another big problem we're seeing at the moment, particularly around fraudulent invoicing. Can you outline some of the problems that you're seeing from your end and how fraudsters are really operating using fraudulent invoices?
Yeah, so fraud's not a new problem, as you're aware. And fraud in itself becomes more prevalent when times get tougher. You kind of look at fraud, you break it into a number of categories, so particularly when it's related to our business. So I would say you've got the deliberate fraud, where you've got criminals who are setting out to take advantage of a system that they found a weakness in. And then you've got, I would say, the people there's a fraudulent opportunity. They're not thinking about breaking the rules, but suddenly the pressure their business is faced on, that's a shortcut, maybe I can do this, and I'll explain what that might be in a minute. So it's not a designed fraud. And then you've got what's going on in the cyber world, which is all around identity fraud at the moment. But if we go back to the invoice fraud, I would say the criminal design fraud is where people understand how an insurance policy works or how a factoring business works, and they find the opportunity to effectively create fraudulent invoices. And sometimes they'll finance those invoices and disappear. Other times they'll just keep pushing fresh air invoices, we sometimes call them, into the system. They keep getting funded until they get discovered. All of the banks, the factors, ourselves have got tools and alert systems to try and pick that up. Those criminals are always one step ahead. They know how the system works. So in those cases, we were as vigilant as we can be. But with technology and with AI and with deep faking going on, it's becoming more and more challenging. That's where we're working with our clients. We're trying to look at these signals that may pop up and collaboratively try and defeat this. You see what the guy is financing his invoices. He says, maybe I need some cash. I'll push this invoice forward, knowing he hasn't actually supplied the goods, hoping that the system won't pick it up. We do see that where people are accelerating their invoices and getting them funded before they've actually supplied the goods. They're hoping they don't get discovered. Often the pressure that comes on a business and that temptation is too much. And a lot of the advice that we give people is all around verification, validation. And that's where our database is very powerful, because we have hundreds of millions of customers on that database. We know people are trading with those companies. We've got those records. We can quickly see whether that invoice is valid, whether the company that is asking for payment is true, or if the person supplying it is who they're saying they are. All of that we can help. And a lot of the invoice factoring companies also have manual verification, calling people up saying, is this a valid invoice? Things get through. People have worked out that this is an opportunity to get away, to fraudulently take advantage of the system.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it. You've highlighted some of those different types of fraud, and it's very interesting that in a world of increased uncertainty, you tend to see a correlation with increased fraud. Question around the types of fraud, given the advancement of AI and deep fakes, as you said, and also the fact that we are in tense, uncertain times. What types of fraud would you say you're on the lookout for now? And is the nature of the fraud changing you've seen over recent years?
I would say false documentation and information is a consequence of the AI. It's false identification. And it's very tempting as an organization, particularly as you say, when there's an economic downturn, you get an inquiry saying, hey, I'd like to buy 1,000 washing machines. You're sitting there saying, I've got an order for 1,000 washing machines. And you go on and your sales guy saying, here's the company, here's their credentials. You go and you check and everything looks good because you can't see any bad signals. And because they've absolutely, completely falsified that identification, the address looks perfect, etc., etc. And the temptation is to go and ship those 1,000 washing machines. And we've seen it. We've seen barcodes on documents that have been cut and pasted. We've seen addresses that are basically got a hole in the walls, but they're inside a sophisticated, New York address. It's intriguing the levels that they've gone to because they believe that the risk for them is worth it. And the risk of getting caught is minimal because at the end of the day, it's a hole in the wall in a downtown office block in New York, but there's actually nobody. It's just a nameplate. How do I check it's true or not true? Again, where we can come in, we'll validate that's the company. We'll check it. We can see that they're operational, and it's becoming more and more challenging for people to do that independently. You go online or you go into Dun& Bradstreet, the information is not consistent. Therefore, how do you work with someone who can give you the pretty solid statement around these guys are good, you should be shipping to them, and you're going to get paid? It's challenging to do that out there on your own. There's a world of drop shipping. Drop shipping doesn't just occur on Amazon. It's happening in big import-export operations that used to have, it's classic, you'd have a warehouse outside the airport in Miami. That warehouse would take in electronic goods from China. They'd sit in that warehouse and then they'd move them to Latin America. Now that situation is the guy just needs to be sat in an apartment and the goods are shipped straight out of China to the end destination. That world has attracted a lot of, criminality. And it's difficult to resist it sometimes. Again, that's where I believe we can help.
How does the industry come together to prevent fraud losses? Because ultimately, it's the job of a carrier to prevent rather than solve the problem after it's happened. And should the industry come together, perhaps the carriers come together to share what I gather is quite a siloed set of data between each organization?
It's a great thought. In fact, it's underway as we speak. We've been having discussions because generally what the industry has, and I've been at industry events where the levels of invoice fraud is definitely on the climb. So I think as an industry, we have a responsibility to collectively understand what's going on, identify what types of fraud are going on, how we can prevent this, how we can advise people, looking at how technology is getting into the ecosystem and how to understand how we can build signals into all of our preventative solutions. As we have the data, as you say, I think it's our responsibility to help the industry and help our clients identify these situations.
Thank you, James. Let's talk about regulation. How will the upcoming US Basel Endgame, or more widely known as Basel 3.1 implementation, impact the demand for credit insurance in the US, particularly given the latest news and particularly for trade and export finance?
The use of credit insurance in Europe as a consequence of Basel has definitely accelerated over the years, and banks really do see the advantage of using trade credit in their risk management, and they've built it into their model. And indeed, you see European banks in the US, because they're regulated in Europe, are taking advantage of trade credit in the same way. US banks, as you know, have been slower they have no reason to, because they can't find a method to discount the capital charge using trade credit. They can build in, they're using it as a mitigation, and they can build in factors into their calculation, but they can't do what the European banks are doing, where they're buying trade credit policies specifically for capital relief. They often say the wind blows across the Atlantic from west to east. Clearly this time the breeze is coming across from Europe, and US banks are realizing, the end game is clear. It's just when is that going to be upon them? We're starting to see interest. We're starting to see banks becoming more curious and looking to use the policy for capital relief. However, at this stage, I think we're not quite there where the European banks are. I think US banks still are one of the largest partners. The bank as a customer in the US is still, a significant part of our business, and where they're insuring their receivable finance business or their ABL businesses, or they're just using as a classic credit insurance policy, transferring the risk over to us. I don't believe in any way they're using that to generate capital relief. And then you've got banks who are telling their clients to buy a credit insurance policy, to use our policy to wrap the receivables. Therefore, that asset becomes a higher rated asset that the bank's lending against. So the banks are using trade credit, but not in the same way as you say we see the proliferation in Europe. But I do see that changing, as you say. You can see the banks are preparing for that Basel Endgame right now. And
Thank you, James. The big challenge is really dealing with that shift of bank capital to insurance capital. And that's really going to simultaneously shift how risk is managed. How can carriers actually support this transfer of risk?
always had the balance sheet to support the levels of exposure on those risks. And that's not been a particular challenge. And our balance sheet continues to grow as we grow, and the more exposure that we put onto the balance sheet as we grow. I think what's happening in these, as you're aware, is that the capital charge that the bank has under Basel and the capital charge that the insurance companies have under Solvency II is the arbitrage there is enabling us to allow the banks to transfer some of that risk onto our balance sheet. That's been going on for many years now. What the banks have to determine is, whether that advantage is worth something to them and worth the premium they would have to pay to us as well. With the way we manage risk doesn't change whether it's a piece of risk coming from the bank, it's coming from one of our clients. To us, we manage the risk in exactly the same way, and that doesn't change. That's part of our obligation to our regulators, that we manage risks in exactly the same way. And we declare our risk management models to the regulators, so it's completely open book. They can see that we will have the limits. It's not a never-ending situation. We will have, if it's certain names, we will have a ceiling on that name. We're going to take all of that risk coming from the bank into our business without some sort of qualification, re-underwriting, etc.
Thank you very much. I guess taking a wider picture of the global trade credit insurance industry, so it's expanding. It's clocking growth of, I think, around 7.5%, or it clocked growth in 2023, which is the fastest growing rate since 2006. James, where do you see the industry going in the next 5 years, particularly in terms of markets, the changing pretense of insurability, and also with the growing inclusion of technology into your practice?
As I said right at the beginning of the conversation, trade credit is still an underutilized solution for many organizations. And that's primarily because if you go into the C-suites of a lot of organizations, it's around 30% will have heard of it. Of that, 30% have used it. So why you're seeing that growth is because, we're going out explaining it. Brokers are investing in the product. We're investing in other distribution channels. Banks are talking to their clients about using the product. So you're getting that effect now that more people are having a conversation about it. How to use it in the business is changing. There are different reasons to use it, not just a pure, I can sleep at night insurance policy. It's now how can I access finance? How can I manage my balance sheet more effectively? How can I manage my cash flow, my receivables? How can I use the companies to help me with export? If I've got a loss in Mexico, how do I manage the court system? Oh, my insurance company can do that for me. So all of those components are snowballing. Why aren't you talking to trade? As you say, you're seeing that growth. The upside is apparent when you look at, as I said, in the US, you've probably got 50,000 companies who are using the product. And when there's 20,000, 30 million that could be.
Thank you very much, James, for your insights and talking about growth as part of this new CEO series. I have one final question, which you will not have prepared for. What piece of advice would you give to emerging leaders or those new entrants entering trade and export finance who want to become the C-suite, who are aiming to become CEOs?
First of all, I'd advise anyone to go for it. It's super fun. It's rewarding. It's hard work. My advice is, as any CEO, you've got an agenda. You need to really understand what that agenda in front of you is. The agenda often has different stakeholders. So you've clearly got the customers, you've got your employees, and you've got your shareholders or your owners, whatever that final piece is, however it's constructed. You need to really understand that landscape and how that landscape works as an ecosystem. Because as the CEO, you're representing those three parties, and you've got to keep that in balance. You've got to make sure that your customers are being fulfilled, what you promised to deliver them, you're delivering. You're finding new customers in that space. So being part of that is critical as the CEO. If you're too far away from that, you're not really get what you need to have as a CEO in terms of giving that feedback to your teams, understanding what the client's challenges are, looking at strategically, how do I plan for the future against those needs? For any organization to be successful, the employees, your teams, are going to have to be connected to you as a CEO. How do you connect yourself to the employees as a CEO? You've got to go out and talk to them. Say, okay, this is what we're going to do. You go back to the 70s and 80s and they talk about vision and mission and all that. It's not really changed. Maybe we don't want to give them those sort of consultancy tags. But if you want to go out and grow an organization or build an organization, you've got to go out and explain that to your employees and understand how they connect. Because people now, particularly the generations that we're working in, they want to come to work and have a purpose. What is my purpose? It's not just salary and pension anymore. What I'm doing in my job, I've got to have a connection to that, and that's going to make me feel good. So helping employees understand how they're connecting to the purpose of the company is important. And again, that's a huge part of the CEO's job. communicating that on a regular basis, being visible, being present, etc. They're the guys who are going to say, okay, we need to grow the business by 10%. We need to manage the risk. So we need to make sure that we're protected from all the regulations that are in front of us. We want to make sure that the company is growing, it's safe, it's profitable, etc. You've got to be able to, as a CEO, make sure that you're giving that group all the confidence they need. As a CEO, sometimes people think it's just standing on the platform saying, here we go. You've got to get that balance correct. So think about how you use your day, because that's your most valuable commodity. And then behind that, you've got to get that balance that's behind that, your family life, your recreation. Make sure you spend time in that as well, because a healthy body creates a healthy mind. And if you discount one or the other, it doesn't end in a good place.
Thank you very much, James. It all sounds a bit like a balancing act, which is coincidentally the title of our latest edition of Trade Finance Talks. That was James Daly, CEO of Allianz Trade Americas. James, thank you very much for joining us on Trade Finance Talks. See you soon.
Thank you very much.